Welcome students, I am Dr. Vijaya. Today we are going to see unit number 18, concepts of insurance, that is from block 5, insurance. Insurance, introduction. Insurance is a means of protection from financial loss. It is a form of risk management primarily used to hedge against the risk of a contingent or uncertain losses. An entity which provides insurance is known as an insurer, an insurance company, an insurance carrier, or an underwriter. A person or entity who buys insurance is known as a policy holder, while a person or entity covered under the policy is called an insured. Policy holder and insured are often used as, but not necessarily synonymous, as coverage can sometimes extend to additional insureds who did not buy the insurance. The insurance transaction involves a policyholder assuming a guaranteed, known, and relatively small loss in the form of a payment to the insurer in exchange of the insurer's promise to compensate the insured in the event of a covered loss. The loss may or may not be financial, but it must be deductible to financial terms. Furthermore, it is usually involves something in which the insured has an insurer interest established by ownership, possession, and for pre-existing relationship. The insured receives a contract called the insurance policy, which details the conditions and circumstances under which the insurer will compensate the insured or their designated beneficiary or assignee. The amount of money charged by the insurer to the policyholder for the coverage set forth in the insurance policy is called the premium. If the insured expires a loss which is potentially covered by the insurance policy, the insured submits a claim to the insurer for processing by a claims adjuster. A mandatory out-of-pocket expenses required by an insurance policy before an insurer will pay a claim is called a deductible, that is, or if required by a health insurance policy, a co-payment. The insurer may hedge its own risk by taking up reinsurance, whereby another insurance company agrees to carry some of the risk, especially if the primary insurer deems the risk too large for it to carry. Next we see on the insurance and its meaning. Insurance is a means of protection from any unforeseen losses and contingencies. It is a risk management technique used for hedging various uncertain losses. Insurance is a contractual agreement between two parties in which one party promises to protect another party from uncertainties and losses. Insurance is a legal agreement between two parties, the insurer and the insured, also known as the insurance coverage or insurance policy. The insurer provides financial coverage for the losses of the insured that she or he may bear uncertain losses. Simply speaking, insurance is a means by which risk of loss or damage can be shifted to another party, called the insurer, on the payment of the charge known as premium. The party whose risk is shifted to the insurer is known as the insured. In simple, insurance is a social device which combines the risk of individuals into a group using funds contributed by members of the group to pay for the losses. Next, we move on to the topic assurance. Assurance is very important in the topic insurance. The term assurance is applied to contracts where the risk insured against is certain to happen, but the time of its happening is uncertain. Thus, the risk insured against the death is contract of assurance. Technically speaking, a life of insurance may be called as life assurance. Assurance refers to financial stage that provides remuneration for an event that is certain to happen. Assurance is similar to insurance, which the terms often use interchangeably. Assurance services can help companies mitigate risk and identify problematic issues. Assurance meaning. One of the best example of assurance is whole life insurance as opposed to term life insurance. In the UK, life assurance is another name is for life insurance. The adverse event that both whole life and term life insurance deal with is the death of the person the policy covers. Since the death of the covered person is certain and a life insurance policy results in payment to the beneficiary when the policyholder dies. A term life insurance policy, however, covers a fixed period such as 10, 20 or 30 years from the policy's purchase date. If the policyholder dies during that time, the beneficiary receives money, but if the policyholder dies after the term, no benefit is received. The assurance policy covers an event that will happen no matter what, while the insurance policy covers a covered incident that might occur. That is, the policyholder might die within the next 30 years. We will see the types of insurance. Assurance can also refer to professional services provided by the accountants, lawyers, and other professionals. These professionals assure the integrity and the usability of documents and information produced by businesses and other organizations. Assurance in this context helps companies and other institutions manage risk and evaluate potential pitfalls. Audits are one of the best examples of assurance provided by such firms for businesses to assure that information provided to shareholders is accurate and impartial. Assurance services. Assurance services are of a type of independent professional service usually provided by the certified or chartered accountants such as certified public accountants, that is CPA. Assurance services can include a review of any financial document or transaction such as a loan, contract, or financial website. This review certifies the correctness and validity of the item being reviewed by the CPA. Examples of assurance. As an example of assurance services, say investors of a publicity related traded company grow suspicious that the company is recognizing revenue too early. Early realization of revenue might lead to positive financial results in upcoming quarters, but it can also lead to worse results in the future. Under pressure from shareholders, company management agrees to hire an assurance firm to review its accounting procedures and systems to provide a report to shareholders. The summary will assure shareholders and investors that the company's financial statements are accurate and revenue recognition policies are in line with generally accepted accounting principles, that is GAAP. The assurance firms reviews the financial statements, interviews accounting department personnel, and speaks with customers and clients. The assurance firm makes sure that the company in question has allowed GAAP and assures stakeholders that the company's results are sound. And here we see the basic differences between the insurance and the assurance. Whereas an insurance provides risk coverage for an event that might or might not be happen, for example flood, theft, fire, disease, etc. In the assurance provides risk coverage for events that are certain in nature such as death. Here in insurance, its coverage is an anticipated event and it is coverage for a definite event. And for the insurance, the claim is paid on the occurrence of the insured event, and here claim is paid either on the occurrence of the insured event or on maturity. In insurance, insurer undertakes to compensate the insured if the insured event happens. Compensation may depend on multiple factors like amount of coverage, amount of damage, etc. Here in assurance, the insurer undertakes to pay the sum assured when the specified event takes place. Again, in insurance, policyholder undertakes to pay premium regularly and in exchange for coverage against risk. And here, policyholder undertakes to pay premium regularly in exchange for financial benefit on the occurrence of the event covered or on maturity. And here in insurance, it lasts for a year and needs to be renewed annually, but here it's run for long term after premium is paid regularly for a certain period. Here general insurance comes under this category, and here only the life insurance comes under this category. Next we move on to the objectives of the insurance, or the main or the goal of the insurance. Granting security to people. Insurance primarily serves the purpose of granting security against losses and damages to people. It is an agreement enters into by two parties in which one promises to protect other from losses in turn for premium paid by the other party. One party is insurance company and the other one is insured. Insurance companies guarantee the insured of compensation in case of any unfavorable contingency. Insured need to pay premium to insurance companies and in return for guarantee of compensation. Minimization of losses. Insurance aims at minimization of losses arising from future risks and uncertainties. It adds certainty of payments to people for happening of uncertain events. Insurance assures the individuals for compensation of losses. It minimizes the risk through proper planning and administration. Insurance companies such as people for taking safety measures like installation of fire detection devices, alarm and camera systems, etc. They also join hands with various organizations like fire brigade, health and various organizations which work for reducing losses and damages. This way, the insurance works towards minimizing the happening of various losses. Next, diversifying the risk. Insurance works towards diversifying the risk among large number of people. It aims at reducing the adverse effects of any future contingency by spreading the overall risk associated with it. It is medium through which people share their risk with others. Insurance companies compensate the insured for losses out of premium they charged from their different policy holders. The loss incurred by individual is diversified among large peoples by insurance companies by utilizing the collected premium amount for paying compensations, reduces the anxiety and fear. Insurance policies reveals the individuals of any tension and fear regarding the future risk and uncertainties. It guarantees them of compensation in occurrence of any unfavorable contingencies. Assurance of compensation is a most relieving factor for tensed and worried people. They are certain of payment on occurrence of various uncertain events. It makes them confident and then they focus on the activities with full attention. Mobilizes the saving. Mobilization of savings is another important object of insurance. It attracts people for investments by presenting them with numerous insurance policies guaranteeing the compensation for losses. Large number of people take this insurance policy in order to insure them against losses and damages. Insurance companies are able to generate large amount of funds in the form of premium that they charge from the policy holders regularly. These funds are then invested by these companies into securities in stock and market and earn incomes. Idle lying resources with public are employed by insurance companies towards income generating sources. Next, we move on to generation of capital. Insurance companies leads to capital generation from collecting large amount of funds from public. They regularly charges premium from their large customers for providing them protection against losses. These funds are invested for industry development by subsidizing to shares or subscribing the shares of companies. Companies are able to get their required capital through insurance industry as they invest in the companies for earning dividends and other incomes. This boosts the industry performance and economic growth of country. Also, bigger investments lead to creation of various employment opportunities. Next, we see features and nature of insurance. Sharing of risk. Insurance is a device to share the financial losses which might befall an individual for his family on the happening of a specified event. Cooperative device. The most important feature of every insurance plan is the cooperation of a large number of persons who in effect agree to share the financial loss arising due to a particular risk that is insured. Value of risk. The risk is evaluated before insuring to charge the share of an insured, here called in consideration or premium. Payment at contingency. The payment is made at a certain contingency insured. The contingency is a fire or the marine perils etc. may or may not occur in other insurance contracts. So, if the contingency occurs, payment is made. Otherwise, no payment is given to the policy holder. Next, amount of payment. The amount of payment depends on the value of loss due to the particular insured risk provided insurance is there up to that amount. A large number of insured persons. To spread the loss immediately, smoothly and cheaply, a large number of persons should be insured. Insurance is different from gambling. Insurance should not be confused with gambling, even though there is a chance factor in both, but insurance is totally different from gambling. Insurance is not charity. Charity is given without consideration, hence charity is different from insurance. In case of insurance, the premium paid by the insured is the consideration. Without premium, it is not possible to take out an insurance policy. Next, we will see the benefits of insurance. An insurance policy performs various functions and comes with multiple benefits. Below are some of its most fundamental advantages, along with some of the secondary, and the rest are additional ones. The basic functions of insurance coverage are: it provides protection. Insurance coverage does reduce the impact of loss that one bears in perilous situations. It provides monetary reimbursement during financial crisis. It not only protects the insured from financial woes but also helps in checking mental stress arising out of it. Provides certainty. Insurance coverage provides a feeling of assurance to the policyholders. The insured pays a small portion of the income for this certainty that help in the future. So, there is a certainty of handsome financial aid against the premium. It will protect the policy buyer when met with accidents, hazards or any vulnerabilities. Risk sharing. The very manner in which insurance policy functions make it a cooperative scheme. An insurer would be able to pay one's capital. An insurance company pools in collective risk and premiums because it covers a large number of risk exposed people. The payout of to the one who claims insurance coverage is out of this fund. Thereby, all policyholders share the risk of the one who actually suffered the loss. Value of risk. Insurance policy assesses the volume of risk and also anticipates the various causes of it. It evaluates the amount of insurance coverage and the premium payments amounts on a risk value basis. It safeguards against unforeseen events and consequential loss. Capital generation. The fund generated from the various premium acts as a pooled investment for the insurance company. The insurers invest their lump sum amount in the money market instruments, for example, in stock markets, mutual funds, and other productive channels. This helps in generating income and profit for the business. It guards against the loss of capital for the company. Economic growth. Insurance policy mobilizes domestic savings into providing financial stability. It also directs towards loss mitigation due to damage or destruction for the insured community. It not only equivalently spreads risk but also promotes trade and commerce by utilizing the fund. Saving habits. Insurance policies helps inculcate saving habits among individuals. They keep a portion of income to pay premiums that will act as a guard for unknown future. Many insurance plans comes as insurance cum savings or insurance cum investment schemes. This further encourages people to save and invest. And these are the basic principles which should be followed by the insurance companies, and these are the basic principles of insurance. Principles of utmost good faith. It states that both the parties of contract must enter into a contract in good faith. They both should reveal all the material information and facts regarding contract to each other accurately and honestly. Insured should tell the insurer all details truly so that the insurance companies are able to calculate the right premium amount. Next goes to insurable interest. This principle states that the insurance policy holder must have insurable interest in the subject matter of insurance. Existence of an object should provide him some benefits and gains. Any damage to an insurance object should adversely affect the insured and provides him heavy losses. Principles of indemnity. Principle of indemnity means insurance contracts are done to provide protection and compensate against uncertain losses, damages, or injuries. Indemnity simply means protection, security, and compensation for damages or losses. Principle of indemnity does not apply to the life insurance contract. Principle of contribution. Principle of contribution states that insured cannot make profit by insuring the property with more than one insurance company. Insurance companies will compensate to insured on basis on principle of contribution, that is, all the insurance companies will share the losses to extent of sum insured with them. Next, principle of subrogation. Principle of subrogation states that after paying compensation, the ownership right of the property will transfer from insured to the insurer. Principle of subrogation allows the insurer to pursue legal methods against the third party to cover the amount of losses. Principle of loss minimization. This principle states that insured should always take all the necessary steps to avoid losses and damages to insured property. Principle of causa proxima. Causa proxima means the direct cause or the nearest cause. The principles of causa proxima are applicable when there are series of causes for losses or damages to insured property. According to this, the nearest and the most dominant cause for loss and damages is considered for calculating the liability of the insurer. Next, we will see the risk and insurability of the insurance. Risk, which can be insured by private companies, typically shares 7 common characteristics. Large number of similar exposure units. Since insurance operates through pooling resources, the majority of insurance policies cover individual members of large classes, allowing insurers to benefit from the law of large numbers in which predicted losses are similar to the actual losses. Exceptions include Lloyd's of London, which is famous for insuring the life of health of actors, sports figures, and other famous individuals. However, all exposures will have particular differences, which may lead to different premium rates. Definite loss. This type of loss takes place at the known time and the place from known cause. The classic example involves the death of an insured person on a life insurance policy. Fire, automobile accidents, and worker injuries may also easily meet their criteria. Other types of losses may also be definite in theory. Occupational disease, for instance, may involve prolonged exposure to injurious conditions where no specific time, place, or cause is identified. Ideally, the time, place, and the cause of loss should be clear enough that a reasonable person with sufficient information could objectively verify all three elements. Accidental loss. The event that discontinues that trigger of a claim should be fortuitous or at least outside the control of the beneficiary of the insurance. The loss should be pure in the sense that it results from an event for which there is only the opportunity for cost. Events that contain speculative elements such as ordinary business risk or even purchasing a lottery ticket are generally not considered insurable. Large loss. The size of the large must be meaningful from the perspective of the insured. Insurance premiums need to cover both the expected cost of losses plus the cost of issuing and administrating the policy, adjusting policies, and supplying the capital needed to reasonably assure that the insurer will be able to pay claims. For small losses, these later costs may be several times the size of the expected cost of losses. There is hardly any point in paying such costs unless the protection offered has real value to a buyer. Affordable premium. If the likelihood of an insured event is so high or the cost of event so large that the resulting premium is large relative to the amount of protection offered, then it is not likely that insurance will be purchased even if on offer. Furthermore, as the accounting profession formally recognizing in financial accounting standards, the premium cannot be so large that there is not a reasonable chance of a significant loss to the insurer. If there is no such chance of loss, then the transaction may have the form of insurance, but not the substances. See the US Financial Accounting Standard Board's pronouncement number 113, Accounting and Reporting for Reinsurance of Short Duration and Long Duration Contracts. Calculable loss. There are two elements that must be at least estimable. If it formally calculable, the profitability of loss and adamant cost. Profitability loss is generally an empirical exercise, while cost is more to do with the stability of a reasonable person in possession of a copy of the insurance policy and a proof of loss associated with the claim presented under that policy to make a reasonable, definite, and objective evaluation of the amount of the loss recoverable as a result of claim. Limited risk of catastrophically large process. Insurable losses are independently and non-catastrophic, meaning that the loss does not happen at all at once and that individual losses are not severe enough to bankrupt the insurer. Insurers may prefer to limit their exposure to a loss from a single event to some small portion of their capital base. Capital constraints insurers' ability to sell earthquake insurance as well as wind insurance in gale zones. In the United States, the federal government insures flood risk in especially identified areas. In commercial fire insurance, it is possible to find single properties whose total exposed value is well in excess of an individual insurer's capital constraint. Such properties are generally shared among several insurers and are insured by a single insurer, which indicates the risk into the reinsurance market. Thank you.